own currency, maybe not in the seas, but it's just as turbulent as the process out there. And really, it's going to play a big role if you have a job in the world of international business. Frankly, there's a niche market here as well for you to sit down. If you want to explore this on your own, you can sit down and make money by sitting there playing the market on floating currency. It's totally different than a stock exchange, but the concepts are still there. The higher the risk, the potential for higher profit or loss as you go through. Let's go and explore the floating currency exchange rate system that's out there. It's all based upon supply and demand for that currency as you go through. If a country sits down there and they have their currency, it rises up against another currency in value as you go through, then all of a sudden you start investing in that currency and sitting down there as it goes up. And then you sit down there and you buy different currencies in the process as you go through. If you go through, let's say, for instance, the US and Canada, the US dollar, once upon a time, I lived in the Midwest, and it was a pretty common thing at lunch hour for people in the city of Detroit, Michigan, to go across the bridge, the Windsor Bridge, to the city, Canada city of Windsor, Canada, and they would buy gasoline because of the fact that the US dollar had an exchange rate of $1.32 versus $1 for a Canadian in the process. So for every dollar that we would spend, it would be valued at $1.32 Canadian. So they would drive across the bridge, they would sit down there, they'd fill their gas tanks up, they'd save $20, $22, $24 on one tank of gas just by taking advantage of that. The only problem, they had to sit down there, wait about 2 hours to be able to get in line to cross the bridge because so many cars were doing the same thing. The Canadians, they profited because they're selling lots of gas, okay, through their own supply chain, and the Americans are doing well because, so both sides won, except for the fact by the time it was all done, you had this giant traffic jam every single day on the Windsor Bridge between Detroit and Windsor, Canada in the process. That's kind of the aspect of the supply and demand on a human level rather than a giant bank level. The Jamaica Agreement established flexible exchange rates among a series of IMF members, International Monetary Fund members, as they go through. So you have this rise and fall, rise and falls. And when you sell currencies, they're always traded in pairs as they go through to sit down there and buy the differential between them. It can be very profitable for active traders, but I would recommend by active, that means you are on it every single day at a minimum and probably multiple times in the same day because it's so volatile, it does move that quickly. Don't sit down there and buy an Egyptian pound with American dollars and just sit back and rest 4 or 5 weeks because by then your whole investment can be wiped out in the process. The pound can sit there and drop between 30 and 40 cents over a week, let alone who knows what will happen in 5 weeks. So be careful on aspects like that as you go through because of the fact that the currency rates will shift a lot faster a lot of times than the stock market will do. And it could be that, boom, all of a sudden they found a huge reserve of lithium in Egypt. Whoa, and all of a sudden, boom, it skyrockets right up and you're holding a short position on it. All of a sudden now you're in real trouble in the aspect of it. So that being said, be careful about it, but you have to be active investor in the process. It's not a good way for passive lenders. It's a good way to sit down and be an active investor as you go through. So they can trade almost any currency in the world through the foreign exchange. We call it Forex as you go through. You bet the value of one currency will increase in relative to another. It plays a lot like the stock market. So the expected return of currency trading is similar to money market, and it's lower than that of stocks and bonds usually. So you have to be a little bit more aggressive, but to some extent, that risk isn't as dangerous as the high volatility of a company announces. All of a sudden, we have a 4% decrease in quarterly earnings, and the stock market goes down. It's not quite that volatile, but you have to watch it and nurse it as you go through the process. Why does it matter? You can sit down there and run your own business based upon the floating currency exchange rate. We'll talk about the 8 different ways that companies sit down there and they exchange money. And that'll really be a good, interesting concept to talk about. But let me give you an example. You're here in the United States. Let's keep this simple. And let's go across the border to Canada as you go through. You go through and you have competitors and everything else, and you're doing really well in the Canadian office of your company. So you're sitting down and you're working on everything else and you're making a profit, and all of a sudden the value of the Canadian dollar drops on a national basis. you're showing that you had a 12% increase in profits. And so you're sitting here, you're all proud, hey, my office, we had a 12% increase in profit as you go through. And lo and behold, as something dynamically shifted in the economies between the US and Canada, then all of a sudden the Canadian dollar drops 14%. So your home office sector says, you made 12%, but we lost 2% because the whole country went down 14%. So yeah, you think you're hot stuff, you actually went down 2%. Whoa, all of a sudden that big promotion, that fancy new car you bought about, it better be in Canadian dollars because over here in the United States, your name is mud, even though you did 12%. There goes your career pathway. It really does play a role, maybe not quite that volatile, but always look at an extreme case. If you're looking at the aspect of, whoa, what does that mean to me? Yes, it means something to you because that volatility between the two countries may not have anything to do with the business that you're doing in the process. You have to pay attention to this. It's an important part of the overall matrix of doing business in the international world as you go through. There's 8 different ways for currency exchange rate. You can sit down and just take any one of these, go on the internet and find all the countries that are involved with each one of them. The textbook does a pretty good job also identifying them, but there's 8, and I want you to know there's 8 types of currency exchange rate systems. I'm going to avoid testing you on the exact specifications of them because there's an awful lot as you go through. But that being said, you have to have the concept that there's different ways that countries sit down and they exchange rate, and there's not one uniform because it's an international world, not one governed by the rules of one country. Exchange rate with no separate legal tender. One country adopts a currency of another, or a group of countries, they adopt one common currency. A lot of times that common currency is the US dollar as you go through. A lot of countries have done that. European Union is also one where they went through a series of countries, they signed an agreement, and they created a brand new monetary system called the euro. So the euro actually is a large worldwide currency used a lot of times in transactions because it represents the same dollar of a unified organization. So you have the exchange agreement and there's no separate legal tender. Everybody agrees they have the same one. You have also the currency board arrangement where a country commits to hold foreign reserves of a specific currency equal to the domestic currency and exchange the two at a fixed rate as you go through. That's a one-on-one between countries as you go through. The book lists several ones in that process as well. And if you were fortunate enough to sit down there and go to a country that has that type of an arrangement, it's going to be a lot easier because your 12% will be reflected on the other 12% in the other country as you go through because you did a good job increasing your sales in your country. It looks good in both countries as you go through. Then you have a fixed peg arrangement where you sit down there and you say, right there, I'm going to peg it right over here, and that's exactly how it's going to be. You have the conventional, which really focuses on with one or a basket of currencies that fluctuate around this specific rate of less than 1%. No variation. You keep it down to 1% or less as you go through. Then you have another one that's almost as stable as that one. It's called, we call the peg exchange rate within a horizontal band. And by that means that you can go above there, greater than 1%. It's not quite as stable as you go through and have the conventional fixed peg arrangement, but it really is within range of that, but you have more flexibility with it and it's more volatile, which leads to sit down that 12% that you just earned may only be worth 8% in the other country from your home office, and that's not so hot, but it may be 16% too. You don't know as you go through. A crawling peg as you go through. It sounds kind of like a bug as you go through. Currency readjusted at a fixed pre-announced rate. This is going to be our rate. Hear ye, hear ye. That's what it is, or response to changes in indicators. It could be a matter of if the following 4 indicators are there, the currency is going to be readjusted here, and all of a sudden you readjust it and you re-peg it as you go through compared to other funds as you go through. And then a crawling band as you go through. No, they don't play rock and roll, and they're not rap either in the process. It's called the crawling band. It adjusts the currency to maintain the fluctuation margins around the central rate. So you have a central rate, and then you have different margins as you go through, depending upon different parts of the economic world at that moment as you go through. And then you have a managed floating fund, okay, where you sit down there, it fluctuates as the country actively intervenes on the international exchange market without specifying its goals. It's almost like a free floating rate, but it's more managed. And the free floating rate is the one that the United States is on, which is really nice because we have a very powerful dollar across the world, to the point that if you go back to our listing of 8 over here, in number 1, a lot of countries use our dollar and they peg their dollar to our dollar as you go through the process. So it's a really nice thing to have floating exchange, and we just watch the market as it goes through. The government may intervene, but it's going to pretty much look to moderate the rate rather than sit there and peg the rate at a currency level. Even China, which is really economically a giant powerhouse, it goes through and it'll actually peg its rate specifically instead of taking the risk of a free floating exchange rate like the US does as you go through. 8 different kinds. Let me just go through them again. The exchange rate with no legal tender, a currency board arrangement as you go through, where 2 countries have an agreement between them, and then you have the fixed peg of less than 1%, and then you have 1% and less, and then the stabilized arrangement where the pegged exchange rates within the band greater than 1%, but it's defined as you go through. A crawling peg where you have a pre-announced rate, a crawling band as you go through that has fluctuations around it, and then you have a floating rate that's managed where a country actively intervenes to keep it within a certain range, or like the US, a free floating exchange rate. 8 different types of currency exchange rate systems. Here's some examples of it. I encourage you to take a look at this. If this is an interest to you, okay, now number 1, at this moment, it could be an academic interest because you're taking this class. But if you're going to go to another country, you need to sit down and spend some time and look on the ways that currency rates are exchanged. It's a matter of you maybe find a niche to sit down and make money in the process for your company, because last time I checked, business is about making money, okay, in the process. So that's part of it. The other part of it is your future could be based upon that currency exchange rate and how they go about doing it. You need to know how that works in relation to your home office where your country is. So you have to sit down there and know the differences between it. And that adds to the dimensions of the complexity of your job. But also, if you know what it is, that gives you an advantage over maybe your peers in the process as you go through. There's a gold system, the Bretton Woods exchange system, and the floating system. Know the definitions of all 3 of these. It's critical, not just on your test, but also if you're transacting business on a worldwide basis, you need to know exactly what you're involved with. So there also is a place called the Bank for International Settlements. It's for central bankers as you go through. In our case, our central bankers are the Federal Reserve System. So they go and they have meetings on an international, the BIS, you'll hear the terminology on a regular basis if you work on Wall Street, okay, that operates the cooperation to order and really foster monetary and financial stability. It's all about stability, trying to sit there and balance it. And they have the discrete financial institutions in the world, all in Switzerland, of course, where everything is kept a secret and everything in the process as you go through. So you'll have that over there. The headquarters for the BIS is actually in Switzerland, and the building doesn't even have a name on it because it's all nobody knows about it except those of us in the class and whoever reads the textbook and whoever reads the Wall Street Journal. All right, anyway, so it's not a secret. So that being said, it's discreet as you go through, and it's a place for central bankers to go and have secret meetings about how they're going to sit down there and try to build better cooperation to really have financial stability as you go through. Floating currency values, the major currencies, they use their central banks to fluctuate against each other. Here's probably the 4 biggest ones: the US dollar, the British pound sterling, and the Japanese yen and the euro. They really do have the floating, and they're out there at the risk, but also because of the fact they're so accepted across the entire planet Earth, that really gives them an advantage against other currencies. Here is some of the different aspects in the aspect of how the euro fluctuates in dollar terms. It does go that volatility. If you're smart enough, you sit down and pick it up when it's low, and then you get rid of it when it's high. You're going to make serious money. If you're working in that country over here and you have a deal over here, then you sit down and you'll see how it affects your business and your bottom line in the country. A lot of times this could be a reason to sit down and open a market, even though it may not appear to be profitable on paper from the fundamental aspect. Just that differences in the currency exchange rate can sit down there and make all the difference in your bottom line as an international business. So why foreign currency exchange occurs: buyers and sellers want to do business in their own currency and avoid risk. That's the biggest thing. So the vehicle currency used for international trade, such as the Denmark market, uses the US dollar. The US dollar is accepted across the world and is viewed as one of the most stable economic international commodities that's out there. Intervention currency used to intervene in foreign currency exchange rates. Well, the problem by using countries that will have the government intervene, you may be sitting there and expecting to have this all of a sudden, and then boom, the government goes in, and not on the exchange rate like we have, but a different and they all of a sudden they mandate, boom, it will now be worth this amount of money. And you may get rich off the process, but usually it's not to your benefit, it's only to the country's benefit, and you may lose a massive amount of money. That's why this is a critical topic as you go through. Currencies are traded in pairs, 8 different types. Know that they exist. And also, big picture, if you do business in a different country, make certain that you know the exchange rate between that country and that of your home office where you report to as you go through. Know there's going to be fluctuating currencies. Know about the Bank of International Settlements, and then it can be a serious issue for a foreign office or a corporate office in a different country when it comes to floating currency. Take care.